TSMC is about to test the entire AI chip trade, not because AI demand is fake. The demand looks real. The harder question is whether that demand is strong enough to support the expectations already priced into AI chip stocks. That is why this earnings report matters. It is not just a TSMC story. It is a Nvidia story, an AMD story, a Broadcom story, and a test for the whole AI semiconductor chain. Real demand can still become an overvalued trade. My view is simple. TSMC may confirm the AI chip boom, but confirmation is not the same as upside. This video is for education only. It is not financial advice. Let's break it down in simple English. TSMC is where AI chip designs become physical supply. Nvidia, AMD, Broadcom, Apple, and other major customers all depend on TSMC's advanced manufacturing and packaging capacity. That makes its earnings one of the cleanest tests of real AI chip demand. If orders for leading-edge chips remain strong, TSMC sees it. If advanced packaging stays tight, TSMC sees it. If customers begin slowing, delaying, or changing their plans, TSMC is one of the first places investors may notice. And unlike a single chip designer, TSMC sees demand across several customers and product cycles. That makes its commentary especially useful when investors are trying to separate one company's strength from a broader industry trend. That is why this report matters far beyond one company. TSMC sits between the AI story and the factories that must make that story real. TSMC reported second quarter revenue of about 1.27 trillion new Taiwan dollars. That was roughly 36% higher than a year earlier. June revenue was also sharply higher. Those numbers are strong. But strong numbers are not always enough when investors have already paid for a perfect AI cycle. The market already expects heavy demand from Nvidia accelerators, custom AI chips, advanced servers, and data centers. So investors are not only asking whether TSMC is growing, they are asking whether growth is accelerating enough to beat the assumptions already inside the stocks. A record revenue number can confirm the business is healthy. It cannot guarantee a positive market reaction. Investors will compare the reported numbers with forecasts, management language, and the strength of the second half outlook. That comparison matters more than the headline alone. If the result is exactly what investors expected, the stock may do very little. If the result is strong but guidance is only cautious, the market may focus on the caution. That is the expectations problem. The business can win, while the stock still struggles. AI chip stocks have already attracted enormous capital. TSMC, Nvidia, AMD, Broadcom, ASML, and Micron are no longer hidden stories. Wall Street understands the AI infrastructure thesis. That changes the standard. When expectations are low, good news can create upside. When expectations are high, good news may only defend the current valuation. This is especially true in a crowded trade where many investors already own the same story and are waiting for another reason to add more. So, this earnings report is not simply about whether demand is real. It is about whether demand is strong enough, profitable enough, and visible enough to justify what investors already believe. That is a much harder test. First, guidance. Does management sound more confident about the second half? A stronger outlook would support the idea that AI demand is still accelerating. Second, margins. Is growth still profitable, or are expansion costs starting to bite? Strong revenue matters less if new factories, overseas capacity, and process ramps pressure profitability. Third, capital spending. Is spending backed by visible customer demand? Higher capex is constructive only when management can connect it to committed orders, tight capacity, or clear bottlenecks. Fourth, advanced nodes and packaging. Are 3 nanometer, 2 nanometer, and CoWoS still tight? Continued constraints would support the idea that advanced AI demand remains strong. Fifth, customer spending. Are big tech customers still building aggressively enough to support the supply chain? If hyperscalers slow the growth rate of AI spending, pressure can eventually move backward through chips, equipment, memory, and networking. The strongest report would not rely on one good number. It would show that demand, profitability, capacity planning, and customer commitments are all pointing in the same direction. If TSMC sounds strong, it supports the Nvidia pipeline. Nvidia depends on TSMC to turn advanced accelerator designs into real supply. But the same report also affects AMD and Broadcom, which rely on advanced manufacturing. It affects ASML because capacity expansion supports demand for chip-making equipment, and it affects Micron because more AI accelerators can support more demand for high-bandwidth memory. That is why one TSMC report can move the whole AI chip chain. But it cannot prove every AI chip stock is cheap. A company can be essential to AI and still be priced for too much perfection. So here's the MarketMind AI 5-question framework. Pause here. 3, 2, 1. Screenshot this. Question 1. Is AI chip demand still accelerating? Look for advanced node demand, packaging constraints, and customer commitments. Question 2. Is guidance strong enough? A strong quarter matters less if management becomes cautious about the future. Question 3. Are margins holding? Revenue growth is more valuable when pricing power and utilization protect profitability. Question 4. Are customers still spending aggressively? Watch whether hyperscalers continue expanding AI capacity at a pace that supports the supply chain. Question 5. Are AI chip stocks priced for perfection? Even strong earnings can disappoint if valuations already assume flawless execution. Demand, guidance, margins, customer spending, expectations. Those are the 5 things I would watch. TSMC earnings may confirm that AI chip demand is still real. But the market is no longer asking only whether demand exists. It is asking whether demand is strong enough, profitable enough, and visible enough to justify current valuations. That is the real test. If TSMC delivers strong guidance, healthy margins, tight advanced capacity, and confident capital spending plans, the AI chip trade may get another green light. But if guidance is cautious, margins weaken, or capacity demand looks less tight, investors may start treating the AI chip trade as an expectations problem. The boom may be real. The question is whether the stock's already priced in too much of it. Comment. Boom if you think TSMC confirms the AI chip story. Comment warning if you think expectations are too high. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.